Hi everyone and welcome. Today we're talking about a hot topic in the trading world, zero DTE options. I'm Francesco Placci and I deal with research and development here at Unger Academy. Together, we'll take a look at what these options are, when they were introduced, how they work, and why they've become so popular among traders. And most importantly, we'll understand the risks and opportunities of these financial instruments. Let's get right into it by figuring out what zero DTE actually means. So, zero DTE stands for 0 days to expiry, meaning these are options that expire on the same day they're bought or sold. That means they only last a few hours, until market close, and their value depends entirely on what happens to the SPX index during that same day. When did these options come into existence? Well, SPX options have been around for decades, and for a long time, they only had monthly expirations. Then came the weekly expirations, and finally, in 2022, the CBOE introduced daily expirations. From that moment, traders were able to trade options with 0 days to expiry every day of the week. And that's exactly when this instrument's popularity exploded. Let's look at the main characteristics that made these options a successful trading tool. First, the duration. They expire the same day, so everything happens within a few hours. You can already see how, from a certain point of view, the line between trading and gambling gets pretty blurry. Second, the price. These are highly volatile instruments because there's no remaining time value. Every move in the index has a major impact. From an options Greek standpoint, this means very high gamma, so extreme sensitivity to movements in the underlying. Theta decays very quickly, whatever little theta these options even have. And delta also changes sharply because of the high gamma. Finally, liquidity. In recent years, they've become so heavily traded that they now offer a very active and liquid market. So let's ask ourselves, why have they become so popular? First off, they allow traders to speculate on short-term SPX moves without tying up capital long-term. They offer opportunities to manage risk or capitalize on market events, such as macroeconomic data, Fed meetings, or earnings reports. And they've gained massive volume, eventually representing a significant share of all SPX options. We'll soon see how they account for over 50%. So why do traders love them so much? They allow speculation on intraday SPX movements. And like I said earlier, the line between these tools and gambling is extremely thin. They allow for targeted hedging around specific events, like macroeconomic data or Fed meetings. They have low upfront costs because there's no time value baked in. And above all, they've hit record volumes. As we've seen, they now account for more than 50%, maybe even 61 to 62% of all global SPX options, so they are the majority. One point I really want to emphasize is the link to gambling that I just mentioned. Profitable trading is often boring trading. If you're looking for thrills and adrenaline, trading is not where to find them. In fact, it's the fastest way to blow up your account. I get the sense that some traders are using these tools almost like scratch-off lottery tickets, kind of like the instant win games that are so popular today. But the truth is, while these can be useful instruments, as we've seen, they're absolutely not easy to handle. Let's look at the volume data for zero DTE options. In 2016, they accounted for about 5% of all SPX options. That grew to 43% in 2023, 48% in 2024, 56% in 2025, 2025, and between February and August, they kept climbing, reaching 62.4%. So a huge portion of all SPX options traded today are zero DTE. And this, of course, can have consequences. But first, let's look at how these differ from traditional options. With traditional options, you can build structured, medium-term strategies. Zero DTE options, on the other hand, are more like surgical tools, designed for specific ad hoc events like macroeconomic releases or important announcements. So these are intraday trades. They're much faster, but they're also much riskier, especially when sold, and they require much stricter risk management than traditional options. Now, regarding the effects of zero DTE options, some market participants believe that the fact zero DTE options now make up more than half of all SPX option volume could distort the market. They argue that the concentration of speculative and hedging flows, especially intraday, might amplify index movements and create a feedback loop with other participants, potentially disrupting price formation in relation to fundamentals. However, as of today, there's no concrete or objective evidence confirming this destabilizing effect. In fact, studies so far, including from the CBOE, which is clearly not a neutral party, tend to refute that hypothesis. So, in summary, the debate is still open. But for now, the idea that 0DTES could significantly move or distort the market remains more of a theoretical concern than a proven reality. But now, what are the risks you shouldn't underestimate? The premium can go to zero within hours. That's great if you're selling the option, not so much if you're buying it, especially in significant amounts. Their implied leverage is massive, so even a small index move can cause huge gains or huge losses. So these are not the kinds of trades you can just open in the morning and leave alone while working another job. You need to keep them monitored and be in front of your screen so you can act fast. That's why they're not suitable for beginners. You need experience, discipline, and extremely tight risk control. There's also a psychological factor. Trading such short expirations can easily lead to impulsive decisions. And again, we come back to the gambling mindset. Now let's look at the most popular 0DTE strategies, the ones you often see talked about on social media. I'm referring specifically to selling these options, which is objectively the riskiest approach. We're talking about naked puts, selling uncovered puts, short straddle or strangle, iron condor, and calendar. This chart shows the payoff of a short strangle, one of the most widely used strategies with 0 days to expiration. It involves selling a put and a call at delta 10. It's easy to see how the risk-reward ratio here is extremely unattractive. You get a max profit of $1,200, but the potential loss is basically unlimited. Let's set aside that issue for a moment, even though it should already raise red flags, and look at what happens if you run this strategy consistently. In this case, we're looking at daily trades starting in 2020, before daily expirations even existed. So we're simulating just 3 trades per week instead of 5, always using options with 0 days to expiry. And what we see is that this backtest shows a losing strategy. It either loses money or, at best, doesn't make enough to justify the very high risk. So how does this strategy work? Basically, you sell 2 options, a call and a put, at the US market, open and close them at the end of the day. It's true that theta decay is significant, but it's clearly not enough to offset the risks. Sometimes people try to improve this by adding protection, turning the short strangle into an iron condor, for example, to reduce the max loss and especially the margin requirements. Because even if this strategy were profitable, the required margin would be so high that returns would be insignificant by year's end. Let's now see what happens if we add a stop loss to the short strangle. Every time the market hits the strike of our options, we close the trade. Sure, there's an improvement. But even so, since 2022, when daily expirations became available every weekday, this strategy hasn't made any money. And this doesn't even include the cost of buying protective options to reduce margin usage. So yes, you can tweak the strategy, but it's not easy to make it work. This strategy is designed to open at the start of the trading day. You can experiment with timing or adjust the parameters, but in my opinion, the edge that this strategy may have had up to 2022 has faded. Why? Because of the flood of liquidity and the explosion in popularity of these financial instruments. That edge has thinned out. We can see this clearly. The strategy performed well until 2022, then just moved sideways. So what conclusions can we draw? First, the strategy, as it's usually presented, especially on social media, doesn't work. Or at the very least, it has a very unattractive risk-reward ratio. To manage a strategy like this, you'd need automation software, advanced risk management systems, and the ability to react within seconds. That's not within reach of most retail traders. So yes, on paper it might seem simple. Collect a small premium every day that goes to zero by market close. But in reality, one unexpected event could wipe out your entire account. So, as we've seen, 0DTE options might look appealing at first glance, but they come with significant risks and require advanced tools and skills to manage properly. If you're just starting out, or even if you're experienced but looking for more consistent and sustainable approaches to trading, It's worth thinking twice before jumping into strategies like these, especially the ones you often see hyped up online. And now I'd love to hear from you. Have you ever traded 0DTES? What was your experience like? Let me know in the comments. If you found this video helpful, don't forget to leave a like and share it with someone who might be getting into options trading. And of course, subscribe to the channel for more content like this. See you in the next one.